physically in one room again together. I think Zoom was getting old for all of us, and I'm very grateful that the situation has ameliorated. And wonderful to see so many friends at many, many tables in the audience today. Where are we in the markets? It's almost a bit of an epistemological question. I don't think anyone can really know with certainty. Hindsight is always 20/20, and as the old saw goes, it's very hard to make predictions, especially about the future. I'll just leave you with some data, and I'll let you form your own conclusions. But one of the things that we have been thinking about a lot over the last several years is how to think about the market cycle. Some of you have been very kind to read some of the reports that we've put together over the years. Thank you for your patience in slogging through them. Our 2021 report, which was published Jan-Feb 2021, we felt that things were getting a bit overheated. We asked a question in 125-point Garamond, somewhere in the back of the presentation, are the markets overvalued? And what we pointed out was on the Warren Buffett metric of global market cap divided by global GDP, the previous peak had been 107%. That was roughly December 2007. And we found ourselves at the beginning of 2021 at already 118%. Things continued to heat up, in part because of the Federal Reserve's policies in 2020 and 21. When we did our 2022 report, which we published at the end of 2021, roughly November, December, we had a very specific answer. We said, yes, we felt the global public markets were horrendously overvalued. And the reason we felt that way is because back in the early part of 2021, that ratio was at 118%. It had risen to 127% by November 2021. Again, global market cap peaked at 122.5 trillion. Global market cap was what it was. The ratio was 1.27x. We felt that it was only a matter of time before the markets would crash. And interestingly enough, again, maybe better to be lucky than smart, we count ourselves lucky in this forecast. The markets have fallen precipitously since the time of that prediction in November 2021. We are now on the Buffett metric at 0.95x. For those of you that are corporate finance purists, you will instantly reject this whole methodology because this is price to EBITDA for Earth. And of course, what you want is enterprise value to EBITDA, but be that as it may. Where do we go from here? Take a look at the right-hand panel. Yes, we have fallen. Yes, it has been painful. But it's important to contextualize this. We have been further down than 0.95x. In fact, considerably further down. If you were to take a histogram of that right side of the page and look at every single reading for which we have data roughly over 19 or 20 years, where we are is actually still north of median. I grew up in suburban America. The shopping mall was my native habitat. And I always remember those maps in the mall that say, you are here. Well, you are here at 0.95x. That is higher than median. And in every recession, things tend to whipsaw further downwards than median and then whipsaw back up again. So there's a very strong possibility, and I hope I don't color the day too negatively for all of you, that we go below 83%, we go perhaps into the 60s or 70s before, as we did over the past 20 years, including post-2008, clawing our way right back up again. Something to think about, something to think about. If we go to 83%, well, that's roughly another 10, 15% decline in the markets. If we go beyond 83%, that's even more than that. Something else to think about is if you just look at how market cap oscillates over long periods of time, you see the thing in the far left, the black line is a very simplistic approach to simply look at the long-term trend. Human beings in nominal dollars create about 7.1% global market cap increase every single year. That's been the case over roughly 20 years. And you can look at the oscillations above and below. We're not technical analysts. We're not big fans of that discipline. But what you tend to find is a bit like in high school physics. You pull the spring this way, it's going to whipsaw the other way around. And the bigger they go, the harder they fall. October 2007 was 50 above. March 2009 was 40 to 50 below. We found ourselves at 27 above. We're only 3 below trend line right now. Food for thought in terms of where we go next. One of the things that I think is very important to think about, and many of you have been following this quite closely, what has happened over the last 5 or 6 months is largely multiple-driven share price reduction. But when a recession really bites and really, really gets its claws into us, it's both a multiple compression and an earnings compression. And oftentimes, forecasters get it wrong. We have to be very humble about this. This is the actual quarterly earnings per share for the S&P 500. And I apologize, it's a bit more of a US data set, but enough of these companies are global for it to be relevant for all of us today. This goes back to 2006. And you can see the 2007-08 recession. You can see the COVID recession in 2020. But here's the important point. People value stocks based on forward earnings. This is what people thought at every moment in time, 3 quarters ahead of time would happen. So it perfectly matches in terms of time. It's just that the blue chart was prepared 3 quarters earlier. They completely missed the 2007 recession. They largely missed the 2020 recession. If you go 7 quarters back in time, not only did they miss it, they thought it was going to be spiking in earnings by 2010. How wrong they were. So keep in mind what's happened so far in terms of share price reductions is largely multiples driven. This black line falling hasn't happened yet, but that is what central banks around the world are trying to do, which gives us room for caution in terms of where share prices go from here. On a happier note, how's Southeast Asia doing? Joji mentioned some very important points a few moments ago. Well, I'll start with something brilliant that the Financial Times did, and sometimes the simplicity of a chart is its power. 4 out of the 6 countries in Southeast Asia currently have GDP growth in real terms faster than inflation. That's actually very, very interesting. Very few parts of the world can make that claim. Southeast Asia can. And that's a very powerful statement in terms of Southeast Asia's relatively safe haven status over these last 5 to say 12 months. If we think about it on a longer time scale, some of you who know the reports we've produced will remember this is one of our favorite charts. This is basically Asia on one piece of paper. And what you see is this wonderful journey. It should make all of us very proud because what you're really seeing here is our parents and our grandparents and their parents pulling themselves up out of poverty, out of subsistence living, into enjoying the better things in life. And we have tended to find that over long periods of time, when countries are in that blue stripe, which we erroneously call the blue golden age, that's when companies can become quite large. Witness C spiking at over $100 billion at one point during 2021. Look at Grab and others as well. What we find very interesting about that blue stripe is that we don't have to look too far to see others that have been in that blue stripe in the not too distant past. You know, China, for example, China was in that blue stripe on an inflation adjusted basis, so it's clean, apples to apples, roughly 2004 to 14. And the majority of China's tech market cap is the products of companies that went public when they were at the exact same zone we're at right now. Now you could sort of think of that as a one-off, but it turns out to be identical to Korea as well. This is fascinating because now 30, 40 years have gone by since these companies were being founded and being formed, and yet the companies that went public in 1975 to 86 are today the big winners, which is why we're excited to see who will the big winners be out of our experience going through the golden age. And you typically only get to go through it once. And we're smack dab in the middle of it. As we always joke with our friends, we'll send you an Outlook invite for December 2031 to talk about India, because that will eventually get into the blue stripe over some period of years. The other thing that's worth talking about in Southeast Asia, and again, some of you may have seen this before, but this is a bit updated, is where are we in the pattern of companies that go public? And here, we can look back to the example of China and see a lot of very useful and powerful parallels. China went public in a very sequential sort of way. First, the telcos went public, then Web 1.0, then e-commerce, then verticalized e-commerce, then e-commerce services, and what's now affectionately called O2O, in effect, businesses that hybridize the online and offline environment. This is a damn useful playbook because while maybe 5 or 10 of these companies were very idiosyncratically and uniquely specific to China, the exact same roadmap for Southeast Asia is precisely 10 years behind. When my friends and I at Sea took our business public back in 2017, we were precisely 10 years in time shifted from the first e-commerce IPO in China. So we would simply say, watch this space. What we do in our small organization is to try to simply paint by numbers. It's almost as simple as that. We look for every empty row on this chart that is not that empty from a China perspective, but not only do these companies exist in China, there are 20 to 40 long-only and long-short managers in New York, London, Chicago, Boston, San Francisco that know these business models who would love to invest in the same business model in a different TAM pool. somewhere else in Asia, which is what we do. We basically go row by row by row, looking for the rows that haven't yet generated a public company and try to find wonderful businesses like Shopback and Red Doors and others and Carsome that could occupy that niche. Now, one of the things that we've noticed, and I'm sure many of you have noticed as well, is how many of our friends have come visiting to Southeast Asia. Super Return was here for the first time versus Hong Kong last week. Many VCs, many private equity people are happening to drop by town more often than probably they did in previous years. And one of the things we really want to emphasize is that as welcome as they are, it's helpful to realize that Southeast Asia is neither India, nor China, nor Korea, nor Japan. Southeast Asia is Southeast Asia. My mom always says when we ask her, does my elder son or my younger son look more like her or more like my dad or more like my wife? And she says, he looks like himself. And that's exactly the way to think about Southeast Asia as well. We love to call this the nutrition facts label. It's the protein, carbohydrate, fat, vitamins, and minerals. And what you'll see is that not just are we different than China and India and North America, we're different from each other. Each of the countries in our region has a little bit of a unique dynamic. It's a bit like the old politically incorrect joke they used to tell in Europe, where heaven is where the Italians make the sports cars, the French cook dinner, the Germans write the software, and the British run Scotland Yard, and well, hell is when the British cook the dinner, ... Every country in our region has a somewhat different set of unique characteristics. What that means in practice, and what continually gets reinvented and rediscovered, is that we think that there's only two very concrete, proven ways to make money in this region. We call it, for lack of a better imaginative expression, strategy 1 and strategy 2. Strategy 1 is loosely the go-to, a little bit of the Traveloka, and other strategy, which is basically focusing primarily on Indonesia, often with the Singapore holdco. Strategy 2 is what Carsome, Sea, Grab, Red Doors, Shopback is doing, which is to do the entire region, but typically from a base in Singapore or in KL, and you'll hear from Juliet later today to talk about that very much. Hope springs eternal that there is a strategy 3. And that could be only Vietnam, it could be only Thailand, it could be only Philippines. Our biggest question mark about strategy 3 is simply GDP size. You know, it is interesting to see how many great programmers there are in Vietnam, but Vietnam has $355 billion of GDP. What we're most focused on is actually the 5th column over here, which is which countries have had a demonstrated track record of expanding beyond their borders. And of course, the British Empire gets a bit of a bad rap for all the right reasons, but it often is the former British colonies all around the world that have built great regional commercial networks. In our case, Singapore and Malaysia have done a particularly good job of being able to expand. Witness Carsome, witness Sea, witness Grab. Interestingly enough, there is one final very unique aspect of Southeast Asia vis-a-vis China, vis-a-vis Japan, vis-a-vis India, even vis-a-vis Australia, which is just as London is affectionately called the capital of Europe, or Miami might be tongue-in-cheek the capital of Latin America, Dubai often gets the accolade as capital of the Middle East. Singapore is becoming the capital of Asia. I don't mean that as a political statement. I'm not trying to hurt anybody's feelings. But if you were to go to LinkedIn and sample the roughly 650 million human beings on LinkedIn and look for everybody that has Asia, Asia Pacific, APAC in their job title. So Joji Philip Thomas, CEO Asia, Nikkei, whatever. He would show up in the 25%. This is remarkable. A country with just 5 or 6 million people has 25% of the global human beings with APAC-wide responsibility, more so than Hong Kong, more so than India, more so than mainland China. The implication here is twofold. Number one, Singapore is going to create software companies because software is too important to simply be left to the CIO, just as war is too important to be left just to the generals. Decision makers who buy software live and work in Singapore. We would be shocked if there weren't multiple billion-dollar software companies in Singapore with a headquarters here in development all around Asia in the next decade. And the second very interesting implication is that Singapore, again, reinforces its role as a springboard to basically connect the rest of the region together, a la Sea, a la Grab, a la Carsome, Shopback, and others. Now, this may sound very selfish for me to say, but it's a factual matter. The Series C and the Series D gap persists. We began talking about this back in 2018 and 19, have been quantifying it every year in purely numerical terms. The old joke that entrepreneurs say as a bit of gallows humor is that it remains easier to raise 5 million or 500 million than it is to raise 50 million in Southeast Asia. And there's a whole bunch of reasons for that, not the least of which is the need for the GPs to pony up several tens of millions of dollars for the GP commit to be able to wrap a fund around themselves. But what's I think most interesting is the extraordinary exuberance of the Series A and the Series B community, for which we're certainly grateful at Asia Partners. If you just look at January 1st, 2019 to roughly last week, there have been 750 Series A and Series B tech Southeast Asia investments made. Now, some of them raised an A and a B, or an A and an A2 and a B. So we would dedupe this to roughly 550 companies. But that is staggering, and what a dramatic difference it is from even just 2015, which is already after the time I had joined C. One of the things that we want to share with you, and this is sort of relatively hot off the press, when we first published this study back in 2018-19, there was a $930 million annual gap. Guess what? Now there's a $900 million annual gap. So I guess, yeah, it's $30 million a year less, but it's still a serious gap. And ask any entrepreneur, what they will tell you in a candid, unguarded moment is that it is very hard to go from the Series B into the Series C and D. And then ironically, the E and the F, when the very large firms come in, that's $100 million plus, that's actually much, much easier and faster and de-risked. So we would almost call it the Series C and D valley of death that many entrepreneurs have to barrel their way through, and we're obviously trying to help from our perspective. Finally, when will the IPO markets reopen? It's a topic that I find very interesting, and I had the very good fortune back in 2017 to lead the IPO of C Limited from the inside as the company's group president. And markets go up, markets go down, but I'm very, very proud of the thousands of employees at C who have produced the world's 18th best performing large cap stock. If you bought a share of C in January 1st, 2018 and simply held it and forgot about it, you would have the 18th best performing large cap stock on earth, which is really wonderful. In many ways, broader than just C itself, it's really about the potential of Southeast Asia joining Germany, Australia, India, China, America on this great chart at the roughly top 20 or so. One of the things that I think is often maybe a little bit underappreciated about Southeast Asia is that actually, if you look at it in purely quantitative terms, we are the world's 5th largest market for IPOs. This is a log-log chart, classic power law distribution chart. America is obviously the largest. No one would dispute that. China is the 2nd. No one would dispute that. Western Europe is the 3rd. No dispute. Then there's a gap. And it's a log chart, so it's a pretty big gap. Latin America is number 4. Southeast Asia is number 5. We would predict that Southeast Asia will overtake Latin America over the next 4 or 5 years and become the world's 4th largest market. The issue is that you don't hear a lot about it in the press because the media tends to cover the top 2 or 3. That's the nature of power law distributions. It's Pareto principle, 80-20, 101. But in aggregate, it is quite substantial. And the second issue, or perhaps as fact, maybe not an issue, is that a lot of this is happening in local exchanges. The SET, the IDX, the SGX, to name just a few, and fewer of them than maybe we might see from China and other countries are happening in the global exchanges that get a bit more attention. But in purely dollar terms, we are the world's 5th, soon to be 4th largest market for IPOs. And many people sort of ask the question, well, how do you go public? Well, obviously you hire a bank, but in a more practical level, what do you have to have? We're gonna talk about 4 things today that really ultimately drive the ability to go public. Rule number 1 is the rule of 25. What I mean by that is, if you look at every internet company or software company that has gone public from non-Japan Asia, AEJ, as the banks might say, and you look at what is their current level of gross profit, this is probably a year out of date, most of them are 25 million or above. Some of them were actually 25 million or less when they went public, but today they're 25 and above. This is very practical. We think of a company that gets to $1 billion valuation on a PE multiple, as many know, as a rhino. We think of a company that gets to $25 million of LTM actual GAAP gross profit as a dragon. You need to be a dragon to go public. That's very, very important. And by the way, that is true not just if you want to go public on a local exchange, it's also true as well if you want to go public in America, 25 or above. Rule number 2, the spike. What does the spike mean? It's very interesting. Now, revenue multiples are obviously falling out of favor, as they should be in this current environment. But if you'll humor me, because the revenue multiples are just easier to compute, if you look at companies that are public from, again, emerging Asia, non-Japan Asia, in software and in internet, and you look at what is their revenue multiple, and this is a little bit out of date, relative to one important variable. Y-axis, revenue multiple. X-axis, cash flow. Companies that are at or very close to cash flow break even get valued at higher multiples. Why? It's about credibility. The business model is working. If you are clearly 6 months away from break even or even 6 months past break even. If you're below that, look to the left, there's actually a credibility discount. And if you're above that, well, then the law of large numbers kick in. People know you're not going to be growing at the same growth rate forever. So in an interesting kind of reverse parabolic way, the optimal is to be at the spike, which is to be just about at cash flow break even, which is why companies that may exceed this threshold are often waiting for now this threshold as well, for them to simultaneously be the case. This is when you, the company, are ready. And we think about this a lot in our own prospecting and portfolio. Now the question might be, you're ready, but the markets are not. You may not be looking for trouble, but trouble may be looking for you. That's the second rule of 25. And many of you know what the VIX is. The VIX is a measure of forward-looking volatility in the markets. We think of it as basically quantitative fear. And this is, as we affectionately say, the shape of human fear. This is the VIX every single day as a histogram from the beginning of 1990 when the VIX first becomes trackable and measurable. And what you see is this kind of interesting, kind of like skewed thing. It's almost like a, I don't know, a math person could probably say it's like a Poisson distribution, but it's something very, sort of unique. And we are currently, as of yesterday, at a VIX of 31. A VIX of 31 is kind of like the 85th, 86th percentile. 85 days out of 100, it's less than the red bar, but that's where we are today. We are at an elevated level of fear, which could even increase as the markets continue what we think will be a downward path. What does that mean for IPOs? Well, it's very practical. When the VIX is less than 25, tech IPOs happen. And when the VIX is greater than 25, they do not happen. Now, technically, there's one or two that sort of, are happening kind of in this zone over here, but we view this as highly idiosyncratic. This is almost like a nautical map. This is the continental shelf, and it just falls off after 25. So with the VIX at 31 today, IPOs ain't gonna happen. But when the VIX is 25 or less, IPOs are open. Now, however, you could think about gaming the system, right? Okay, the VIX is very, very, very high, and then it drops to 13 for whatever reason. Could you go public? Well, unfortunately, it's not quite as simple as that, because there is finally the other rule of 40. Many people know the rule of 40 from software and SaaS, revenue growth plus cash flow margin greater than 40. It's a very sensible way to look at businesses. It captures the trade-offs between growth and profitability. But the other rule of 40 is very straightforward. And if I decode this for a second, if the VIX has spiked above 40, or maybe even above 35, at any point in the 90 days leading up to your IPO, you spook the markets. People don't want to do TTW, testing the water meetings. They don't want to hear from the analyst community for the PDIE, pre-deal investor education. They just don't even want to go through your materials. The mood is wrong. It's like telling a joke to the wrong audience. But if over the last preceding 90 days, things have been relatively benign, then you can do it. So summing up, where are we right now for Southeast Asia? You'd be surprised how many companies there are that have at least 25 million of gross profit. We're lucky to have 3 in our portfolio and more over time, and many others do. You'd be surprised how many companies are getting closer and closer to cash flow break even. Some no, but many yes. The VIX is 31 right now. That's a clear red flag. And has the VIX been greater than 40 over the past 90 days? Not really. It's kind of been in the 30, 20 sort of zone. So if only one of those fails, the lock doesn't turn. So the lock is closed right now. But as we start thinking about the next few years, we're very focused on thinking about, all right, who's going to cross the rule of 25 for gross profit? More companies than I think many people realize in this room. It's very interesting. Who's going to get to cash flow profitability? Well, guess what? If there's a Series C and D gap, you got to get to cash flow profitability. That's an existential exigency. You must do it. When will the markets be below 25? Probably not right away. But again, 80% of the time, even 80-something% of the time, they're typically lower than 30. and probably 70% of the time they're lower than 25. So that's a relatively good fact. And will this dynamic persist as well in terms of spiking? Hard to tell, but we'd be unsurprised if it spikes above 40 at some point in the next 2 or 3 months. All of which sums up to say we think the IPO markets are back open sometime in second half 2023. That's our best guess at the present day, and we advise companies accordingly. I'm going to pause over there. We probably have time for maybe 1 question or 2 questions, then I'll wrap up and get you back to the rest of the day. Gentlemen, sir. You know, it was not that, it was probably the single most benign time to go public. It was the single, I mean, let's be honest, the Federal Reserve's balance sheet went from like X% of GDP of America to 38%. There was so much capital out there. It was probably the optimal time if the goal was optimizing for valuation.
But then, so just curious, the VIX really spiked up afterwards? Or?
Absolutely, absolutely.
That's what happened. So you have to also make sure the VIX is not about to spike up in order for the IPO to be successful.
Those guys are friends of mine, so I will simply say no comment.
No, I'm not referring to grab. I'm just saying, in a general sense, you have to, right?
My view of IPOs is maybe a little bit old-fashioned. Mm-hmm. My view is that you should price your IPO such that the first day close is 10 to 15% above the IPO price. The first month close is 10 to 15% above the IPO price, and the first year close is 10 to 15% above the IPO price. Now, that's a hard thing to do when the markets are so ebullient, because the aspiration and the incentive is for many companies to want to take full advantage of that. And I actually have to say, I understand where they're coming from. No one would criticize a company for raising debt at very attractive terms if interest rates rise. But companies do get criticized for a whole bunch of reasons for raising capital at very high prices if the markets and therefore the cost of equity rises. But if the goal is to be able to be a repeat issuer of equity over the next 4 or 5 years and keep fueling the business, it's a helpful thing to have a first day close 10 to 15, 1 month close 10 to 15, first year close 10 to 15, and to beat analyst consensus 3 or 4 quarters in a row. That puts you in the position that C was very helpfully in over the last several years, where it could raise many billions of dollars in additional capital because of the credibility that we had earned.
So then would you advise, if there was an expectation of the VIX going up, that you should resort, or you may be in the borderline of high and low VIX, that you go for private capital?
I would say that if your company needs capital, and if the opportunity to go public is there, not to over-obsess about what the VIX might be a year from now. The VIX simply tells you whether the door is open or closed at that moment in time. Mm-hmm. What I would say, though, is in situations where the VIX is 12 or 13, markets are unusually placid, I would often advise entrepreneurs, and I'm not calling any one particular company out and saying this, resist the urge to reprice your IPO $2 above the filing range. There's a lot of value in life in leaving a little bit of money on the table to share the benefit with Fidelity and T. Rowe and the many others, because they'll have your back then when times are tougher.
Right, but my question was, does the same rule apply for going for private capital? Because private capital, of course, these guys will come in and push you down on your valuation. But is that a better way to do if you need the capital?
Well, it's a very interesting and maybe a bit of a philosophical question, and I hope I'm answering the question. If I'm not, please correct me. Public capital is the mother's milk of high growth companies. Why? Number one, it's cheaper. The public investors, not because they're not smart, but because of the nature of the liquid product, are looking for a 10 to 15% annualized return over a period of years. Private capital is typically 25% plus. So right off the bat, it's better. Number two, as an entrepreneur, your entire pref stack collapses to common. That's a beautiful thing. All that multiple sword of Damocles hanging over your head becomes common stock. Yeah. And number three, the single best reason to be a public company in America especially, you can now avail yourselves of the convert markets. A private company convert is a discount to the IPO price. A public company convert is often at a 40% premium to your 90-day VWAP and has a 2% interest cost. In fact, as a public company, the convert markets are the only time you get a free lunch because your own emerging market volatility turns into option value, which depresses the coupon. It's a wonderful gift that technical markets give. So I always advise private companies to consider being public companies once they cross those thresholds. And frankly, if the VIX is very low, private markets will be open as well. But if the VIX is low enough, going into the public markets, it's almost always the right decision.
Right, of course, in the right circumstances.
Very much so.
Yeah.
One last question, and then I'll get out of here.
Dushan from True Global Ventures. So given also your gaming background, maybe it was in the stats, maybe not, but how recession resistant would the gaming sector be?
That's a great question. I personally think that the gaming sector has, and I don't mean gambling to be very clear, I mean the video game sector has a cycle that's actually shorter than the economic cycle. So it's a bit like when we were in high school and did trigonometry, you've got a sine wave. The game sector has had recessions where it was very resilient. Everybody remember the Wall Street bros who were fired in 2008, who were sitting with their Xboxes for most of that year looking for their next hedge fund job? That was a big thing for the game industry. What we're seeing right now, though, is a little bit of a game sector downturn, not just in valuations, but even in some companies for revenue. So I would tell you it's less about being recession resilient. It is actually quite recession resilient. It's more the own internal cycle of the industry, which is actually driven more by content. I get the sense that I'm probably delaying the next speaker here, so I'll probably wrap things up. But, sir, I hope I answered your question. Okay, great. Thank you so much for asking it. Thanks, everybody.